In case you're wondering what's on the menu for today's show, it's not tacos. No, is the taco trade over? Trump hits tariffs last night. We'll talk about those, the impact on the markets. Could that overdo two big earnings reports, Apple and Amazon? Apple, surprising. Amazon going in different directions today. Other reports, Roku, First Solar, Reddit, downgrade a UNH. Boy, I'm glad I got that. But if we turn into a value market here out of growth, who knows about stocks like that? Jonathan Corpina, 835 from the floor in the New York Stock Exchange. He's got a lot to cover on the first day of August. It's pre-market prep on Friday.
The volatility right now is really incredible.
Wow, look at that consolidation on the upper right chart.
You know what we've seen this earnings season? Some of these expected moves get even more violent. This is why I have switched my strategy 10 years ago. And if you're chasing, you're in trouble.
All right, back to following the S&Ps. Down 60 handles is 63.14. Actually dipped under 6,300 here. Buy the dippers emerging. The buck struggling with triple digits, but up 15 cents at 99.89. TLT deep in the red here, 58 cents, 86.34. USO pulling back from the $80 level, down 34 cents, 79 and a quarter. GLD going up this flat, 302.90. SLV taking the hit today, down 0.72%, 33.08. And Bitcoin, well, we had a consolidation up there near the high of the move. Are we breaking out of the lower end of that consolidation period? Let's bring on Dennis this morning. And Dennis, you know, the show, the market going up every day, no volatility. Well, things are changing here on this Friday morning ahead of the jobs report. I didn't even mention that.
Yeah, lots of economic data coming in here this morning as well. Trump putting a little bit of sour cream on the taco trade. He goes through with it. So no kicking the can down the road. Lots of country getting tariffs. Canada, nice 35%. So tariffs begin, and the market doesn't like it. The market started selling off a little bit with Amazon. Obviously, that was a catalyst last night. Apple tried to stem the tide, but it's leaked too. It's holding on a little bit. But then you look at the taco trade with, Trump not chickening out this time. So is that officially dead? That is the questions. But tariffs have went in. Market not liking the tariffs, and that is the main reason why we are down 50 handles this morning.
Key reversal, not a term that we mentioned a whole lot, but we made a new all-time high pre-market trading. Couldn't get there in the regular session, took out the previous day's low and closed below the previous day's low and closing price. So the buy the dippers are ready. Martin's in here. He is ready to buy the dip today. This is it. This is the buy the dip opportunity.
It has been. I mean, every time we've gotten a pullback, again, I'm going to say what I said yesterday. The dip that I would be buying would not be on your value names, not on those names. I still think the AI trade is the way to go. Now, it's overextended and needs a pause, and I wanted more than a 2% dip on most of these names. But, obviously we're in a lot of these names here too. But still on my shopping list, and if they're not on your shopping list, is obviously NVIDIA. AMD, have both of those in long-term portfolio, big positions. Dell is another one I have in there. But, if you got SMCI back at 50, maybe you're thinking about those ones. Maybe you're thinking about a lot of these AI names. There's just a ton of them there. Micron in the 90s, I like. It's not quite there. Its relative strength's been very poor, down to 106. Maybe at 100, maybe you're getting in there too. I think it's going to give us an opportunity, though, and I don't think the AI trade's going away. And I also don't think that the AI trade cares about rates. The AI trade's a little bit concerned here this morning and down because of Amazon, and maybe we should start there, before we talk the macros, and we can talk all, the tariffs. But really, we knew that this was the date and didn't kick the can down the road and signing, a lot of, papers last night to make the trades actually happen. I want to bring the Brentster on here, though, because Brentster was following the Amazon call very well.
Good morning.
Brentster, how are you?
Doing good this morning.
Let's talk a little bit of Amazon here, because this is your big loser of the day. It's one of the biggest positions in my long-term portfolio, so I'm taking it pretty hard here this morning. It's down 8%. The numbers themselves, if we've got the numbers, and I'll just read off the numbers, look okay. I mean, this looks like an okay quarter. $1.68 versus $1.30, 167 versus 161. That's a big beat on the top. That's a big beat on the bottom. They raised Q3 sales guidance 174 to 179.5 versus 172. So Brentster, what the hell happened?
So during the call, there was a question about AWS. The exec who answered in the context of AWS said that the company has more demand than they have capacity. In other words, they have a lot of demand, but they're not able to execute on that demand because of capacity issues. Seemed like in the context of AWS, the capacity issues were like power generation, like electricity, like they were having trouble generating enough electricity. The exec said the capacity issues would take several quarters to resolve. The issues would get better each quarter, but they would take several quarters to resolve. I think when that several quarters comment got dropped on the call is when you saw Amazon shares sliding around 5:05 p.m. last night.
And just continue to slide. I mean, we did get hit on the initial report, so maybe it was initially the numbers, the bar was just too high for Microsoft and Meta the day before, which we talked about that bar being high. The expected move was down 13, and we were down about 5 or 6. And then to your point, those commentary came off, and that's when we really had the move down. And we know in the last few days, they're not afraid to go through the expected move. So, we're down 19, which is 6 points below the expected move here. I mean, you start looking at the technicals, Joel, break down the Amazon numbers here and levels, are we got date back with 200 here again, or do the buy the dippers emerge before then?
There's a level I like ahead of the 200 level. And let's just call it 211.50. There were 3 lows back June 24th, 25th, and 26th. Pre-market low comes in at 1365. So trading just above. So, I mean, it's not a bad area if you get down there today. Just as far as like the expected move goes, we in Microsoft, what was interesting about it is opened up and went straight down, but ended up finding support at the top of the expected move. So if you took home some short-term puts or some weeklies or something, you got short the stock, you just want to make sure that it takes out the pre-market low. But if in fact it does, I'll be looking down at the 212 level. In order, I think, to get positive back about this thing, let's reclaim that 50-day moving average at 217.39. This was trading up $7 in the pre-market yesterday. $7.50. I mean, ahead of the report. I mean, with a high bar out there. So pretty good sell-off here in Amazon. I guess demand is good, having over demand, but if you can't meet that demand, that's not such a good thing. But when it didn't pop, I was watching the price action, and it tried to rally a few times, but usually they take off, they go right away into it, and it's just been the leak was on, and then Brent mentioned those comments. So Amazon traded down 1871, 8% here to start the session.
So stick on here, Brent, because we want to go through the Apple call here too with you. And I was listening to the Apple call as well. Stock report at 4:30. Initially popped like 215, then gave most of it back, and then popped back up to 214, and then has continued. I actually got to 217. It shows. I did not see that. Mm-hmm. And then the leak continued here. So there was, a decent report here, just giving you the numbers here, and actually not even a decent report. It was a great report. The numbers on Apple were really strong. Yeah, so we had $157 versus $142, $94 billion versus $89 billion. So they beat on sales by $5 billion. iPhone sales were up substantially here. What was interesting is listening to the call, and I thought the same thing. I'm like, how much pull forward was there here? Meaning, like, how many people were buying to try to get ahead of the tariffs? Tim Cook came on. He estimated 1 out of 10 points of growth. So you're trying to like, okay, well, what the hell does that mean? 1 out of 10 points of growth. So the growth that they had in the quarter, he estimates that 10% of that growth was pull forward. I'm not so sure how you even estimate that number. So I don't know like what metrics you would use to actually gauge how much pull forward happened. Are you interviewing people as they buy and saying, why are you buying? Oh, I'm buying because I'm nervous about tariffs. Probably not. So I'm going to say, just
Likely.
guessing, that was just, a number you just threw out, just drew a number out of nowhere. So I think that they maybe talked about it, but I think that number is just fugazi. I think it's just made up. So I don't see how you could actually measure that. So I think the pull forward could have been a little bit more substantial than Apple's letting on. And, it was a great sale for iPhone. So the numbers were really, really good. But the question is, if everybody, that wanted to buy an iPhone bought it a little bit early to get ahead of the tariffs, that means the next couple quarters could be a little bit weaker. He had that question too, and then he was asked saying, well, Q1, which is the last, which is their December, October, November, December, because they're on their fiscal year, is typically the strongest quarter. So they were pretty confident in the year numbers. But I don't know. Pull forward's interesting there. So, and then the other thing, why the stock popped, Brentster, and you could probably comment to this too, was commentary on AI.
Yeah, and Dennis, a compliment is due here for you because you have such a good reading on the pulse of what the market wants to hear. Your comment yesterday on Apple was, show me you're not a consumer staple company. Show me you have any kind of AI innovation. And from what I could tell while I was listening to the call, the only comment that got attention for the market was when we heard about increased CapEx, increased capital expending being attributed to AI. That was the comment. Increased investment in AI. Stock popped about $7 as far as I could tell. When the execs were asked, okay, tell us a little bit about some of these AI developments, Tim Cook said, we're working on a lot of things, but we can't specify. So the market was asking for more info on the AI. They didn't get it, and they didn't really care. They still were very thrilled to hear that from Apple. Was the move higher justified? I don't know. I mean, you would have liked to hear some more specifics, obviously, I think, right?
Well, yeah, and I get that they can't give specifics here either because they don't want to, like, when you're working on something, you don't want to let competitors get an edge on you here. So maybe it's true. Maybe they're working on some awesome things here, and they just keep it so secretive that we don't know. It also could be the case that they're working on bending a phone. They're working on improving Siri, and these are things that, bending the phone is not necessary, but Siri improvement is definitely necessary. So, I don't know. The transparency is obviously not here. So it's difficult to say if they're actually, working on that stuff or not. But remember, as of right now, Apple is a consumer staple. And, we have a risk-off day, and consumer staples are holding up well. So I don't think it's going to be like, oh my gosh, Apple's just going to go and roll over and die here. It's trading like a staple with a high multiple. And I think it continues like a staple with a high multiple until otherwise. So, there is the AI component that could be here. They're working on it. And maybe they do come out with something like mind-blowing. But I think I want to wait to invest in Apple until I actually see that mind-blowing thing that say, holy crap, that's going to move the needles. That's going to drive the sales. This is no longer a cell phone company. This is now an AI company. I'm waiting for that moment still.
The numbers were good. $157, $142, 94 billion versus 89 billion. They give all the revenues for all the wearables and Mac sales and stuff. But you know what? This is a setup that I think you just got to be patient here. Popped over this 215 area, which has been resistance. Haven't really spent any time over 215, going all the way back. You haven't been over 215 since March, and they came in with their selling shoes on both of those pops. And then the bottom of the trading range has been right around 207. Now, you got there at the end of the session yesterday because we were a week at the close. Didn't quite get there in the pre-market. So for the volatility that's been in the market, going up, not participating on the upside, not getting hit today, you got to respect that trading range. And that's going on a month. I mean, that was a small candle for the month, higher on the month. Let's see if it can finally get above 215, hold 215, hold the bid. Then, there's potential here. takes out that 207 right by the 50-day moving average. Right now, you're smack dab in the middle. The expected move of Apple, I had it at $9, so trading under the expected move.
Waller comments here this morning, so I just want to go back to Fed speak a little bit here before we start going into some of the other earnings reports, because he is commenting on all this stuff this morning. They're asking why he dissented, because Waller wanted to actually lower by 25 basis points. One comment that struck me as true but surprising was that he said tariffs are not inflationary. It's a one-time increase to price. I guess you could say that, like the 15% comes in, it's got to go somewhere. It's not like it's going to continue. But you imagine prices going up 15% one blow? I mean, what kind of damage does that do? So Procter & Gamble this morning saying they're going to be raising prices. So, I mean, we can say that tariffs are not inflationary if you're going to say, well, it's a one-time thing, like how stocks do. Oh, that's a one-time event. We just don't misprice that. And maybe there's a point to be made there, but man, I'd much rather have a 1% increase for the next 15 years as opposed to a 15% increase, like bang, you get hit with it. So I don't know if that necessarily means that, the economy doesn't feel that one-time increase in price. But, but he's saying, that in the case, well, then, and then he's dissenting, and saying, I would think interest rates should go down 25 basis points because, it's going to be no inflation. But I don't know, man. That big one hit, that's it's going to show up somewhere.
It has
at least
to, right?
At least once.
Yeah. Boy, oh boy. Subject of debate here. Also, we got a jobs number coming out at 8:30 on top of everything else that's going on with the earnings, and expecting to see a slowdown in job growth. So we'll see how that impact. Big week. I mean, big week for earnings. Big week. Fed didn't really do anything. Still, the chances of those rate cuts, despite what Waller's saying, is diminishing here even now for September. So, Paul, keeping the bullets in the chamber now, even with some dissent. But we'll see what shakes it.
There was two
8:30.
Fed members that dissented, I believe, only two.
Yes.
So it was.
I don't know.
It wasn't like it was a split decision here.
I just wanted to pop in and add that Waller said he dissented. I don't know if you said this, Dennis, but it was hinged on job growth. So Waller said, why would we keep the rates steady when we risk a potential serious decline in the labor market? So I think this is valuable because it just shows you where at least one Fed member's head is. He is concerned with job growth, wants to get rates lower to spur some of the growth there. I'm not saying that I agree or disagree, but just that's where at least we have one Fed official angling.
One thing is, we do not control what the Fed does. We can't control it on this show. We, as traders, we can't control what is happening around us. We can only process that information and make decisions off of it. And when the Fed tool's coming down, and showing less chance, you got to be cautious with, small caps, XBI, interest rate sensitive stuff. JC Pratt, we haven't talked about him for a while, posted out a great tweet here this morning showing just on a chart that the IWM made a new, yesterday was the lowest closing price ever for the Russell 2000 relative to the NASDAQ 100. Lowest price ever. So relative. So IWM small caps are now spread out farther from the QQQs than we've ever seen. That's not surprising. Like, that's what we've been saying, is the AI trade is safe. If you think of the macro environment, that kind of just sums it up all in one tweet. Nice job, JC. This is like where we're stand. Small caps, small biotechs, a lot of stocks in the real economy want lower rates. AI trade doesn't care about lower rates. They're going to be getting growth no matter what. So, I mean, that chart in itself says a lot. And that's why I keep thinking, like, hey, if rates start to actually go down and we say, okay, they're lowering now for sure, then you start thinking about buying your IWMs. Then you start thinking about buying your XBIs. Then you start thinking about your interest rate sensitive names. Until then, I think it's still tech.
Is lowering interest rates a quarter point or a half a point really going to offset the potential loss in jobs from AI? I mean, I think it's just a Band-Aid. I mean, people can,
Well, that's a problem too, Joel, and it's a good point. What we were making that point yesterday with that chart from Microsoft, which was concerning as well. I mean, it's just a lot. Like, if you're not invested, if you're just going to sit, I'm saying it again, if you're just going to sit in your value names and wait for the catch-up trade, you may be waiting a long time here because the world is changing around you. And there's a lot of companies that are going to benefit from AI, and there are a lot of companies that could potentially be harmed from AI as well. So I think you've got to separate that, and you've got to be looking at what you're invested in. You know, UPS, you're like sitting there with your 7% dividend and saying how I could go wrong. Sure, if interest rates start going down, you know, maybe UPS picks it up. Everything bounces. Stock went down straight down 20 points here in 3 days. It's due for a bounce. It's oversold. But as a trade, sure. As an investment, I think you're looking in the wrong place, man. I think the reason the story stocks are so hot, the AI story, is because this AI movement is for real. Now, valuations are stretched. Could the whole market correct? Yeah, I'm kind of in that camp. I think we've just gone too far too fast. That's why I'm sitting, you know, with a pretty good chunk of cash here now, slowly raising up on reps, but, you know, holding my core position in AMD, holding my core position in NVIDIA, holding my core position in Amazon, despite it being down 20 points here today, holding my core position in companies that I believe are going to benefit from AI, looking to utilize some of that cash that I have and move it into AI names still. Like, I wouldn't mind being almost all invested in AI. Just valuations has gone too far though now. So now we got to wait for a pullback. Micron on the shopping list for sure. You know, 90s on Micron sounds pretty darn good. I think you got to have lots of different companies on your shopping list here, but I think we've got to stick with the thought process that value catch-up trade, that small cap catch-up trade, Tom Lee style, just may not happen.
Yeah, well, they always call for some big gains. John asking about the move in Shopify here. Does trade with Amazon, traded down 277, holding up pretty well. Don't know. I don't think they have reported yet, but you got a clear level on it. You need to get back above 122 here. That was a pair of lows from Wednesday and Thursday. So just looking at that, easier to identify resistance than support in this one right now. The close here at 22.21 for Shopify.
Remember, Shopify is also Canadian.
Yep.
So I'm not sure how tariffs are going to work on Shopify, but, you know, it's a services. Is they going to tariff the service? I don't know how all that's going to work, but I think they just get lumped up with that today too. When Canada, EWC is having one of its worst days in a while. Here it's down 0.97% in the pre-market. So they are taking note, you know, that Canada got dinged at 35. A lot of other countries are sitting at 15. And Canada looks like, you know, Kearney's a little bit elbows up here either. So this could last a while.
But overall, and whether it's the effects of the dollar or being, you know, rich in resources and everything, since this whole tariff, I mean, this has participated in the rally since April. The EWC, the ETF in Canada. So, you know,
currency effects here too.
Yes,
you know, in a lot of these ones, you got to consider the currency effects here as well. U.S. dollar has been very weak, so you know that overall maybe, you know, a little bit added strength to the CWC.
All right, you want to go to a good report? You want to go to yeah. Okay, let's get some positivity going on this pre-market prep. Reddit, Dennis's favorite website. How did Reddit do? Reddit beat. Big beat. 45 versus 19. That is a big beat, over double. Sales 499 versus 424. Strong guidance. Better than expected. Q2 results. Strong guidance. It's ripping. Reddit ripping off the pre-market high. Do my technicals real quick. Get them out of the way. 193.89. Pull back to the 185 area. 186. Just kind of holding in there. Dennis, Reddit trading 16% higher in a down market.
I mean, hard to chase in this market here. Even to the point, you know, if you're chasing Microsoft yesterday, you got hurt. If you were chasing Meta yesterday, you're doing okay because Meta actually opened and is holding up fairly well, but still off those highs. Bears have come out of their caves. You know, we talked about this last couple of days here on pre-market prep and in the STN room, that the bears are out of their caves right now. Are the bears full on taking control of this market? No. but they're out of their caves. Like a week ago or 2 weeks ago, the bears were in full hibernation, hiding, like just out for, the whole winter here. Well, the winter, it's now spring. And for the bears. And the bears have emerged from their caves and they're making a case. Didn't make a very good case in Microsoft or Meta, but hell, they made a good case in a lot of other stocks yesterday. So, I mean, I think in this market environment, despite Reddit, it's not going to be impacted from tariffs much. It's not like that. But it's just, valuation stretched here maybe at this point in time. The stocks run a long ways here. It's hard to chase when the bears are out. It's okay to chase when the bears are in full hibernation, but when the bears are out from their caves, I think chasing stocks is not the way to go about it. So I'd lay off on Reddit being up 25 points.
Okay, yeah, you're trading in this upper quadrant here. Like I said, got over 190. Do we have any daily levels that go in with that? No, we don't. If you're looking for a level ahead of the pre-market level, 190.92. Do we want to sneak one more in here?
They want to talk Fig. I mean, the IPO went crazy yesterday. It was priced at 35, opened at 85, and ran to 120. It's up another 20 points here this morning, 136. Kramer went on the hugest rant last night on this stock and said stocks like this makes him scared. He talked about an overall bubble because of stocks like this. He did not hold back at all. Like, I've got his commentary here. He said, this is an absurd valuation at 60 times sales. He said 60 times earnings is expensive. 60 times sales is absurd. He said, Figma's law, what goes up must come down. He was so wound up, he started throwing stuff at the television screen. He said, put this genie back in the bottle. The Figma carnival should be over. He was absolutely irate that the stock went up this much. I've never seen him so convicted on selling something. It was 145 when he started going on that rant, so it has come off to 136. Nobody can short it because it's the first day and you can't borrow the dang stock. But, I would have shorted it on Kramer's rant because he started knocking it down and people were selling. Does that mean it can't go back up? No, because this is all FOMO and algos mixed in with retail, hope and everything else. So I'm with them. I don't buy stocks at 60 times sales either, but it's also not a reason to go short a stock usually either.
1 day of price action. I can't just give you the
really
pre-market high and pre-market high. Oh, Fari, remember Fari? How many months of data did he need?
We want like 9 months. We should get Fari back. We need Fari back.
We'll get Fari back. He'll be fired up. 148.80 is that pre-market high. I'll just call support at the close if you get back down there. Way down there, $21.50. $21.50 before that all-time closing high price at Fig Newton at $115.50.
We're calling it Fig Newton forever, are we not?
Yes,
I did the same thing yesterday. I was like, I can't help myself. This is Fig Newton forever.
Software creation. Boom. I'm not how I have to.
Make help with websites with AI.
Oh, okay. AI.
That's what they even do.
Jobs. What's going on with
Redster jobs?
Jobs
Bureau of Labor Statistics expecting the reading for July. We are expecting non-farm payrolls at 106,000 jobs added. That's going to be down about 40,000 jobs from the month of June. Reminder that we are going to get revisions for our past month or two with this July report. We're also expecting private sector payrolls right at 100,000. The unemployment rate, consider these the 3 data points you should focus on: non-farm, private sector, and unemployment rate. Unemployment rate expected to tick just a little higher from 4.1% to 4.2% for the month of July. We got 30 seconds till the data, folks.
Whoa. Okay, it's going to move. We're going to move. Remember, the bears are out of their caves here, so I do think RIPs get sold. I think if we pop, I think the RIP will be sold quickly here. I think people are nervous about tariffs going forward. So I would use a RIP to lighten up, and that's what I intend to do.
34
so we'll in 10 seconds here. Jonathan Corpina will be coming on after to talk this number.
34.25 mid-range on the session. Don't really have anything else in there. The algo
jobs data is light. Non-farm payrolls, 73,000 jobs added. We were expecting 100,000 jobs added. Private sector payrolls, 83,000 jobs added. We were expecting also 100,000. Unemployment rate does tick higher to 4.2% as economists were expecting. Little chop here, little move lower. What about a 13, 14 point move lower here?
From the actual number, actually, we're getting right back up to it. The one, let me go to the 1 minute here. I just want to see where we close. We closed at 1750, and the pop was snuffed out at 23 even. Didn't get back to mid range. Coming back down, and I haven't made a new low for the session here. So they were predicting a little bit of slowdown. So what does this do for rates? Well, you did have the TLT trading in the red there. It did get a pop up to 86.90. So the TLT is moving up and the SPOOs are moving down. Does this pressure Mr. Powell at all here for rates for a rate cut? Now, there's the silver lining in the market. Not such a great jobs number, but does that mean a separate back interest rate cut back on the table? I'm not so sure. 1 month's worth of data, but there we go. Where we've shed about 7 handles. That's about it. But
TLT is rallying on this though, so if you bring up the TLT, we are getting a little bit of a lift here off this. It's muted, but you can see on the top right chart there that we are lifting here in the last few minutes. So bonds are saying, hey, this maybe gets us a little bit. I would imagine if we look at the Fed tool that, in a few minutes here, that there's a little bit uptick in probably September. Brentster, you want to make another point?
I just wanted to say that the revisions for June were pretty sharply lower. Not a huge surprise. We have been on this trend where we'd be getting pretty sharp revisions lower for the prior month. The June non-farm figure was revised from an initial 140,000 down to 14,000 jobs added. Yes, from 140,000 to 14,000 jobs. The private sector June figure was revised lower from 74,000 jobs added to just 3,000 jobs added. 3,000, jobs added. So sharp revisions there.
IWM not rallying on this. So TLT rallying, IWM not rallying. So IWM may be concerned, about the soft labor, but, you got to think like this is move. TLT is moving up because they think, hey, a little better chance. Can we look at the Fed tool and see if there's any immediate change? How long does it take?
It takes about 10 minutes to update.
Let's come back at the end of the show and see the update. I think we're at like 47% chance yesterday of a September cut. I would imagine that's bumped up into the 50s here off this jobs number.
Let's do it. Make it out. Deal. Sold. I'll be back at the end of the show.
Okay. I want to get Jonathan's comments on this too. So let's just bring him right in this conversation. Maybe play the guest intro here, Brentster, and we'll bring Jonathan close.
Jonathan Corpina.
Good morning.
Partner, at Meridian Equity Partners, and nice easy Friday for you.
Here we go.
Yeah.
Way to kick off the month of August.
Yeah, you were. I know you had a busy July, and you said, "Yeah, get me on in August," and we get you on the first day of the month here. A lot of different directions we can go in with this interview, Jonathan. But let's just start. Let's start with the most relevant or the newest information we have to digest, and that's the July jobs number.
Yeah, we watched it unfold right in front of our eyes here. This is going to add a little spark from the White House. I'm waiting for the next tweet to come out.
Yeah, we know that
for President Trump to put a little bit more pressure on the Fed here. This is a soft report, and especially with the revisions that you guys are talking about, this is showing us and might be giving a little bit of a runway for the Fed being forced into making a decision. I quickly checked the odds as we were coming into the show here. They ticked up a little bit since this report came out about a cut in September. So I think if President Trump wants a cut as soon as possible, the data that came out today certainly will help his argument. And I think, Dennis, as you said a few times, the bears are starting to come out. These markets have gotten so lofty with the same headwinds that we've had in front of us. It was only a matter of time before some catalyst was going to put pressure on this market. That's what we're seeing now. The economy is getting better, but probably at a much slower pace than we've seen before in the past. And this might be, the time for the Fed to really take a step back and look at what they're going to have to do in the next month or so to get that room to a point of agreeing to cut rates. So this data today, as much as we would have preferred to see stronger data and better revisions, this data today is kind of giving us a picture of where we're at, and this information is going to probably force the Fed to making a move in September.
So, Jonathan, are you seeing any institutional bears come out of their caves? Like, talk about over the course of the last month, because we've had this relentless bull market, AI stocks, Nvidia, doubling in the last couple of months here, AMD ripping higher. Obviously there's been a lot of FOMO out there. Are you seeing still that FOMO here in the last few days? Are you seeing institutions starting to think about taking profits here? What's the institutional trader saying now?
Yeah, from the buy side of the institution, right? The buyers who we've seen, there hasn't been a tremendous amount of chasing as this market continues to get lofty, because as I said before, there is this expectation that we are going to see some sort of pullback in the market. As we've ticked higher and higher from the institutional side, we have seen more selling, but not pressure selling. I wouldn't call it panic selling when we start to see some volatility in the market. It's very structured, it's very layered, it's very price sensitive as the market has moved higher and higher. Going to be interesting to see just the trading activity as we get into August here. Yesterday was the last day of the month, so you start to see a lot of activity associated with that, which isn't always correlated with the direction of the market, but volumes were certainly higher yesterday. And from the flow that we saw, it was a little bit more convincing as we were getting closer towards the end of the day, and the market started to take that downturn of being able to sell out of some positions. But as we see the S&P futures this morning, pressure on it today, and as we get into August, it's going to be interesting to see if we can get through a few trading sessions without any real pressure or any real panic. This is a reaction right now of what we're seeing, but if you start to see a lot of trading activity and volume associated with that, we're going to see that pattern continue. Let's just back up a year. Last August, things were pretty quiet. We're all looking forward to looking ahead at the election, watching the market trade the way it was. And Bank of Japan comes out, unexpectedly cuts rates. VIX spikes to 65 one day. I think I was on with you guys back then. We were talking about it, and we had a pretty ugly 4-day panic last August, and then the market seemed to kind of find itself again. So coming into where we are now, where we're trading at these levels, it does feel a little fragile to me. We still have geopolitical risks. We still have interest rate risk. We still are talking about tariff deals that keep getting punted down the road. Not many victories on the Trump list as far as tariffs are concerned as of now. So the impact of the tariff headline, I think, has become quite muted on the market. So a lot of things can push this market one way or the other. I think for now, as we get through the summer, there's probably a little bit more pressure on top of the market than supporting it.
You also have institutions, though, that kind of missed the move, right? I mean, V bottom, quick bottom back in April. Having to chase. I mean, is this a pullback? Like, how do you look at this market technically? And are they ready to deploy here on day one after a drop of 100 and 150 handles in the S&Ps? What about the underinvested money managers?
Yeah, S&P moved from 5,300 to 6,300 in the blink of an eye, and certainly people were waiting down below to find some cheaper stocks. It was already pretty cheap, but to find some cheaper stocks that were down there, and they missed that move. These are the opportunities now. Again, today's a Friday. It's the first day of the month. We're getting selling follow through from yesterday. Clearly, the earnings reports from last night didn't help our market, not helping our market. The tariff headlines not helping our markets. We're going to have to see follow through. If we get to the middle of next week and still have pressure on this market, I think this is when we're going to start to see some of these buyers coming back in who might have missed this trade coming up. Because once we get through August, we're going to get towards the end of the year. We'll start having the conversations of money on the sidelines that's missed out. Eventually, they're going to have to come back in. We're going to talk about the syndicate market and the IPO market, as we saw yesterday. That should start to heat up at this point. So there is going to be a lot of activity that's coming down the line, a lot of headlines that can help this market. So I think if we do get pressure next week, we will start to see some of these buyers come in, but they're going to be picky because we know the volatility in this market, and watching the VIX, this market can move 1-2% either way rather quickly. So when the buyers come back in, they're going to be very price sensitive and picking their spots.
Right, takes days, right? If they want a position or something to build a position in a big stock. So let's go to earnings. And we've had some reactions, big beats. My Microsoft that was sold. There's no doubt was sold off hard, bouncing back today. Meta held its gains much better, pulling back today. Give us your overall take here. We got most of the big guns out of the way. We still have a lot of companies report. We still gonna get a beat on the retail sector later on. But give us your appraisal of Q2 earnings so far.
Yeah, we're well through earnings season right now. We're going to get some consumers, we're going to get some travel, some retail, a bunch of different sectors coming up. That'll give us some good insight. But what we've saw the last 2 days between those big four names, I mean, God forbid we would have gone 4 for 4 on those, and that what the impact on the market there. But clearly we've got like this mixed bag here, and the headlines. I think the market and investors aren't really looking at top line and bottom line. They're really looking at outlook and AI spend, and that's been the conversation in every earnings report that's come out after. And who's in front, who's leading it, who's playing catch up. We can see that there, right? Apple has continually over the last few quarters fallen behind in the AI space. They're trying to see where they fit into that. They've stated that they are now going to start putting some capex towards AI, and whether it's internally or externally going out there. Apple's been stuck in this range of 200 to 215. I think investors, myself being one of them, was hoping that this report could have given them that boost to break it out of the range there. But I think Apple's kind of stuck in this rut. They haven't come out with a solid new product in quite some time. So Apple, somewhat of a overall disappoint. I think that's helping this drive down in the market. Amazon, AWS, it's a tremendous profit center for them, missing on some of the numbers there. So that we're going to start to see that pressure there. And then when you look on Microsoft and others, it's the AI spend, and Meta, right? It's the AI spend. They clearly display that in their earnings reports. So investors were happy with that. Unfortunately, the move that we saw in Microsoft and Meta, we're going to see pressure on that today, thanks to Amazon, Apple, and some DC headlines. So again, the volatility is going to have to shift all of this back and forth. Give us a few days to see where this all pans out by the middle of next week. We're going to get our normal economic calendar next week, and again, we're going to continue through earnings season. Hopefully, we see some bright signs in discretionary spending and some other areas.
Rotation, the lifeblood of this market, right? Rotating out of just about everything else and into AI here, with still with the uncertain picture about interest rates. Continue to favor the tech and the AI, or is that value trade? Are we just people waiting too long? I see Berkshire Hathaway trading up today a little bit more, and Apple's acted as a staple. What about the rotation in this market, or just stick with what got us here, and that would be the AI trade?
Yeah, I think that's where we have to stay now until we feel like it's broken. There is that FOMO aspect of it, and if it's not broken, let's not try to fix it. The AI trade, whether it's individual companies or the larger companies who are making those investments, has clearly paid off in this time. We are seeing pressure, overall in tech over today, and that's probably going to lead to a few more trading sessions. But I think overall we've seen that safe, not safe, but that trade has been focused there. But if we continue to see pressure on this market, we'll see a very quick and swift rotation out of tech, get into some of the more with the safer defensive sectors, or we might see some of the ones that have been beaten down pretty bad. Going to be interesting to see how real estate plays out as we continue to have this interest rate conversation, and we're seeing the pressure to get that done there. Financials have performed well, as we've seen in earnings season, with the uptick in trading activity and the anticipation of syndicate and IPO revenue. So we might see that rotation come out of tech, but if we do, it'll start to happen towards the end of next week. And when it does, it happens quick, but very quickly it can pivot back right in. So I think kind of sticking with what has worked so far, which has gotten us from that, again, that 5,300 level up to the 6,300 level, has worked. We should stick with that for as long as we can.
Going to the IPO market, FIG, large IPO on the New York Stock Exchange yesterday, trading up yesterday, trading up today. Not much data on it. We had a very brief short squeeze a few weeks ago, which sometimes people say symptomatic of a topping market. The stock holding up pretty well. Let's just talk about the speculative fever here in the IPO market. Do you see more coming on the line at this time, or think things gonna calm down a bit on the IPO front?
Yeah, I think we've waited collectively a very long time for this IPO syndicate market to reopen, right? And we had to wait and pause as the election season was going. We've gotten into 2025 now, and we've obviously seen the activity in the markets. Investors, institutional investors, retail investors have been waiting for the IPO faucet to open. With this large IPO that we saw yesterday, I think this is the start of others to follow, considering how the process went, how the pricing went, and how the trading and the results have gone. What the thing that does concern me is just these crazy lofty levels, heightened anticipation and heightened participation in something like this is just showing me the yearning for getting involved in something like this. There were people who had no idea what Figma did, what kind of company it was. They just knew it was. They saw it on a list of hot IPOs, and the retail investor pushed that thing well into the hundreds. So we need to be careful about participation and pricing on some of these, because quickly, if we have too many of these that trade at these lofty levels and then come down rather quickly, they're not supported either by the banks or other institutional investors, we might start to see a pullback from participation on those. So we should start to see the syndicate calendar continue to build and grow. There's a lot of companies that have been sitting on the sidelines waiting to go public. Who's going to go first? They're going to see the reaction of it. Now that there'll be a little FOMO on that aspect too. Who's going to rush to the door next to be the next IPO? I think we're going to start to see that open up, and again, that's going to help the financials once we start to see more of these.
So you've seen a lot of rapid appreciation in a lot of stocks. Let's just go to SoFi as an example. And then you're seeing offerings coming out now. This one seems to be scooped up. That offering was at 2085. Talk about the psychology of the companies with the offerings here, doing this at good price. They seem to be being well received. I see MP Materials. So where you at on all these recent offerings?
Yeah, I think it kind of ties into that same concept again of where we've had companies, whether they've been waiting to come public or public companies that have been waiting to do offerings, waiting for that right time, waiting for that right opportunity, for the political landscape to quiet down as much as it could, for the economic holdings to get stronger, and we're starting to see that come back into play. So I think we're going to continue to see this from the syndicate side, from the offering side, and again from the IPO side, where we have these companies that are feeling comfortable to get back in here. And then the output of these, right? When you've got a company that goes public, when you have a company that does an offering, right? They're raising capital. They're raising capital for a multitude of reasons. They're investing in their own company and their own infrastructure. They're investing in people, or they're going to go out and use that capital to go acquire other businesses, other companies, whether they're public or private. So this is all very good for the ecosystem of building and growing our public companies and our economy.
Just going back to this jobs number, and maybe to put a little bit more of a concerning tone on it. I mean, summer hiring. Wouldn't you think that as far as the seasonality trade goes, summer vacations, summer camps, a little tick up on that. Is that another thing that makes this job report even more concerning than what we see on the surface?
Yeah, I mean, I didn't have the opportunity to dig into the numbers here, but the seasonal jobs aren't sustainable, right? We know that's going to come for the summer businesses and the summer jobs. We know that's going to come in November and December for the holiday season. Those are points that we know things are going to occur, but it's not sustainable when we're talking about the overall job growth and job sustainability and our economy. So we're going to have to dig deeper into these numbers here, but I do think that this is a report that wasn't helpful for the Fed. They're going to certainly feel the pressure, not only from the White House, but I think they're going to start feeling pressure from across the street. And they're putting themselves in a position. They've played the wait and see game long enough, and at some point they're going to have to blink. At this point, I think this report, which they were waiting for, we were waiting for, is one that's going to help push them to a point of cutting rates. They're going to have to do it slow. They're going to have to do it measured, as they've done before, as rates rose to where they are now. But making that first step is going to be important. It's going to be interesting to see in August the Fed cut rate percentage, how high we can get that one up to.
To just finish on seasonality here, coming into the month of August, doesn't Europe take the whole month off or something like that? I mean, is that to say? Talk about seasonality. Talk about August. Talk about getting into more into the second half of the year. Historically, more volatile months here in September, October. Let's talk about seasonality.
Yeah, again, go back to August of last year. Everyone was kind of getting ready for their vacations and just watching the market do whatever it had to do before the elections. And then we had that headline come out of Japan, and with the lack of volume that we had in the market at that time, caused a tremendous amount of volatility. I don't think we'll see that now, because I've seen volume tick up throughout this entire year so far. I've seen participation upticks so far this entire year. But we are going to get to this point of August where, yes, people are taking vacations, both Europe and United States, before kids go back to school, kids go back to colleges, families are doing their things at this point. That doesn't mean things will slow down. It just means that there's not as many people paying attention to what's going on, and there might be some things that slip through the cracks. But when we get towards the fourth quarter here, there's certainly going to be a lot on our calendar that we're going to have to get through. And I think the volatility most certainly can be there. It's not going to be from a lack of participation or volume. It's going to be from a geopolitical headline, a Fed headline, a White House headline, a tariff headline that's going to move our markets.
Jonathan Corpina, managing partner, Meridian Equity Partners, joining us here on Pre-Market Prep. Jonathan, always a pleasure to have you on. We'll be dialing you up again real soon.
Yes, sir.
Thank you.
Great. Thanks for your time, guys.
Thanks, Jonathan.
All right, the Bradster's in the background with the Fed Funds tool as the TLT.
Yes, I am. I'm going to pull down your screen share,
Sure.
Joel, and I'm going to share screen, and we can take a look at the Fed Fund, the CME Fed Watch tool together. Cool. So here we have the September. This means 40%, just under 40%, no rate cuts for September. This is showing a 63% chance.
Huge pop.
Also Financial Juice had a headline that said futures implied traders see a 75% chance of a 25 basis point cut at September meeting, up from 45% before the jobs report. We're not seeing that 75% reflected here in the Fed tool, but we can consider it between 60 and 70% or so. Let me just click over to October and to December real quick. About a 15% chance in October of no rate cut. And then clicking over to December, this is back down, no chance of a rate cut, about 5%. The market is basically expecting to price in 2 Fed cuts for 2025 following that jobs data.
it's finally like showing up a little bit that they can get, some data here that'd be like, hey, this is a data point that would say we should cut rates. We haven't been seeing
Sure.
this a data point. So
Sure.
one data point doesn't make, everyone change their minds instantly here on the Fed, but it's a building block to get them thinking about September. And if we go back to that September, yesterday when we looked at this, I think it was 47. So I think we jumped like 15%. Which is
I think you're right, Dennis.
I think it's significant. When you jump 15% like that, that is significant. So that's a significant fall.
Also, just not something that we report on normally, but just a little odd here. After the U.S. jobs data, the chance for an ECB rate cut went up, which the ECB was like convicted that they're not going to be doing any more rate cuts, but now it's looking like money markets are pricing in about a 60% chance of a 25 basis point ECB rate cut by December. That's up from about 50% before the jobs data. Again, thank you, Financial Juice, for that great headline there.
Yeah, I want to give a shout out to our listeners on the Financial Juice platform too. Glad to have you participating in pre-market prep. We only have a few minutes left here. Coinbase, you want to do the
Yeah, I mean, this stock is continuing to leak here, Joel, and it's not a bad one to go look at. We're bringing up the chart here right now. It initially got hit down about 30 and then bounced, because that's what they do. They bounce, because they're loved and the buy dippers can't help themselves. But it's continued to leak ever since that initial bounce. 12 cents versus $1.35, 1.497 versus 1.68. It was a miss and a miss. I don't know if there's one-time items in there or what it was, but because I didn't dive in, there was a lot of other reports to listen to. I did not listen to the Coinbase conference call, but definitely surprising to some investors here. I think the degree of the miss, we can see that in the stock being down 10.5% here today. It's a quiet disaster here for the crypto crowd.
Yeah, but this is taking a hit on Robinhood as well. Boy, pick your poison in here, folks. I mean, between you went from 300 to 350, in majority of that in one day, and now here you are back in no man's land. I guess for today. We'll see if you get down to the 50-day. I mean, if you're looking to buy the dip here, that comes in at 324.18. I don't know if it will get down there today. We'll see what kind of selling pressure comes in off the open. You did get under 335. Pre-market low comes in at 333.98. So $4 away from that. We'll keep an eye on that. But let it settle down. See if you come back here to that 50-day moving average.
I want to talk about this separation between the TLT and the IWM, because this is actually very surprising to me.
Okay.
So, as much as I was like, the IWM is not the place to be long term, on data point like this, it should be the place to be short term, because and it's not. And it's continued to leak. So bring up the TLT and the IWM if you want to bring them up right beside each other from this morning. I don't know if you can do that, Joel, but it would be great.
Oh, yeah.
So IWM is very close to the lows of the morning, and TLT is just continuing to rip. And usually these two are pretty linked on economic data days. And if we look just obviously at the daily, you're looking at the daily, but if you can see it, the TLT is
it's
ripping.
15 minutes.
It is ripping. Stocks like AT&T and Verizon are ripping higher. Staples are ripping higher here. Why? Because those interest, people are in those stocks with the dividends. Those dividends are more attractive if interest rates actually start going down. IWM needs lower rates as well, but it must just be the economy that they're worried about here. And they're like, crap, like that's trumping any hopes of the interest rate, increase in cuts. So I don't know. Like, I think IWM should bounce. It's down 1.8%. If TLT wants to stay up here, I think IWM should bounce. But maybe we're just in this overbought market and they're nervous about it. So long-term hat off, short-term trading hat on. I think stuff like IWM should bounce. Like home builders, I think should bounce here a bit. They're showing a little bit of life. Some of them actually went green here this morning. Think about all those interest rate sensitive names. Those are the ones you're trading here today. I'm not saying we're going and investing in these names. I'm saying we're trading these names. And this is one data point here to build on here. So I'm very surprised the IWM is as weak as it is.
We have inflation data coming out. It's not going to be until, I believe, not next week, but the following week. So, you get some, and another month of cool inflation data, then maybe gives Powell a little bit more push on interest rates. So, Dennis, great breakdown of the markets yesterday. The rotation that was going on today, down across the board. The buy the dippers have made quite a few attempts here to rally, going on the heels of the TLT. So it's been tough. It's been a tough road to hoe here, even with the TLT moving up. So we'll see when things bring the liquidity off the open, what the institutions are doing. Monday, we'll get a view from across the pond with Michael Hewson. So we're going to wrap it up today on pre-market prep. Folks, good luck out there. Everyone have a great week.